Hello, this is Dan Passarelli with Market Taker Mentoring LLC. Today we'll be discussing using Vega to maximize opportunity. I need to point out that options are not for everyone, and you should read characteristics and risks of standardized options before trading. And you may attain a copy of that by calling 1-888-OPTIONS or emailing me at dan@markettaker.com. Vega is one of the Greeks. Now, it's technically not a Greek letter. But it is one of the Greeks that we use in option trading to measure and define risk. Now, Vega is a specific Greek. Specifically, it measures the rate of change of an option's value relative to a change in implied volatility. Now, much like all the Greeks, they're pretty fluid. Vega is different for different options. A couple of rules of thumb that'll take you pretty far if you're trying to get a handle on Vega. Near the money options have bigger Vegas than in the money or out of the money options. That is, specifically, they have a greater sensitivity to changes in implied volatility than in the money or out of the money options. Longer term options have higher Vegas than shorter term options. That means that given the same change in implied volatility, a longer term option will be more affected in terms of its value than a shorter term option. Now, is Vega good or bad? Well, it could be either. It simply measures if there is a change in implied volatility, this is how much I make or lose. So depending on if you're long or short Vega, and if the change in implied volatility is up or down, depends whether or not it helps you or it hurts you. Whenever you buy an option and thus have a long option position, you acquire positive Vega. That is a positive sensitivity to changes in implied volatility, where if implied volatility goes up, you make money, and if implied volatility goes down, you lose money. When you sell an option, you acquire negative Vega. That is, when you sell an option short and acquire a short position, you end up with negative Vega. Negative Vega has an inverse relationship with volatility. When implied volatility falls, the option position gains in value, and when implied volatility rises, the option position loses in value. Implied volatility is a really important part of option trading. It can make a really big difference. Now, this is a screenshot of some Agilent Technologies options, and you can look at the October 29 calls. And if you look down in the Vega column, you'll see that I have the Vega for the October 29 calls circled in yellow. The Vega is 0.0255. That is 2.5 cents worth of Vega, or 2.55 cents to be more accurate. That means that on this $2.80 option, if implied volatility rises 1 point, the option gains in value 2.5 cents, up to 282.5. Implied volatility falls 1 point, the option loses about 2.5 cents worth of value to 277.5. Now, that 2.5 cents might seem sort of unassuming, might seem insignificant. But you'll notice that the column next door shows the implied volatility, which in this case is 78.82. In some cases, implied volatility can really change drastically. Imagine that implied volatility here fell 20 points, and you had purchased these calls at $2.80. Implied volatility falls 20 points, that's 50 cents worth of option value that the option would decline in value. 2.5 cents times 20 volatility points. that is a pretty big percentage of your options value. Even if the underlying doesn't fall, a trader can still lose a lot of money if implied volatility moves against him when Vega translates that implied volatility change into an option premium gain or loss. There's something in options called the rush and crush. And this is one of the reasons why implied volatility is so important. Before an expected volatility event, like for example earnings or something else, maybe an FOMC announcement, it's very common for implied volatility to rise, to become very high, higher than normal. This is called the rush of implied volatility. When implied volatility rises through Vega, we see option prices rise. But then what's common is that right after the volatility event, we tend to see implied volatility fall drastically, get crushed. So people who buy options shortly before a volatility event run the risk of losing a lot on a volatility crush. This is something you really need to be very careful about, and you need to start looking at implied volatility in Vega on each and every one of your trades, especially in times like these where implied volatility is very high here in the fall of 2011. Whenever you make an option trade, you're trading volatility in one way or another. Long option positions have a bullish stance on volatility. You want volatility to go higher, or at least not fall. Short option positions have a natural bearish stance on volatility. You want volatility to fall, or at least not go higher. Now, because you always have this volatility position, sometimes it's not wanted. Trading spreads can help one hedge off unwanted Vega risk. Credit spreads, debit spreads, these sort of things help minimize Vega, making it a more pure directional or time play. This has been a presentation of Market Taker Mentoring LLC. You can learn more by visiting my website, markettaker.com. Have a great day.